Welcome back. Now, at the half-year mark, the building retail sector has not realized expected growth from the lower inflation and interest rate environment, along with benefits of the two-part retirement system. But despite this, Cashbuild has cemented a 4% rise in headline earnings per share, while the dividend is virtually unchanged at 326 cents. Company's CEO, Werner de Jager, joins us with greater perspective on the half-year that was. Werner, thanks so much for your time this afternoon. So as mentioned, revenue up, HEPS up. On the surface, numbers really look good, but you have said that the group has not reaped the full benefits of that lower interest rate environment, that low inflation environment, as well as those the two-part system withdrawals. Just contextualize the performance for us as we get started, Werner.
Yes, you're 100% right. We've expected as an industry to perhaps get better numbers from the two-pot, but when you look at Stats SA figures, building material retail still down 2.7%, whilst some of the other retailers are performing much better. So in light of that, we've followed our own strategy, been very aggressive on our cement pricing, and we believe we're attracting more customers by our policies and the way we're doing business. We've seen 7% increase in feet into the store, which it's quite pleasing for us in these difficult times when consumers are cash strapped.
So you'd say that, the state of the consumer hasn't improved in a sense, because we are seeing a consumer that, yes, is in an environment with less inflation as well as lower interest rates, but they are a consumer that's more indebted, right?
That is correct, and although the consumer seems to be getting slightly better, it's still building materials is a discretionary spend at the end of the day. And we're not the first port of call, so we know it'll take a bit more time for us to start seeing the benefits.
Werner, talk to me about the shopping trends that you are seeing. Are shoppers still picking up the smaller items like tiles or like decorative items, or are you starting to see a level of change within, the cement, the bricks?
Yeah, so we have seen during the 6 months we have seen a change towards, let's call it, wet trade, cement, bricks, and those are performing much better compared to in the past where our decorative items performed better. So it does seem like consumers are busy starting projects again or finishing some of the unfinished projects, which also bodes well for the future, because after that they will need the finishing and the decorative products again.
And looking at your profit margins, I see that there's a slight decrease from 24.7 to 24.3%. What led to this? Was this a function of, that consumer that's under pressure? Was it tough competition? And is there room to lift prices?
It's purely competition, and we took a decision to be very aggressive on our cement pricing so that we will be the cheapest on cement in our business, and that has had the effect of eating into that gross profit margin. We are working on it to get it back to the levels it was, but we will do it responsibly, not to hurt the top line in getting there. Consumers are still, like I said, under pressure, and we can't just willy-nilly pass inflation that we get from suppliers over to the consumers.
And talk to me about your cost base and how you've been keeping a lid on costs. I see operating expenses decreased by 5% in the half-year period.
Yeah, that 5% includes a impairment in the prior year results, but even if you strip that out, the increase would have been 5%, which is still very well controlled. We've always been a company that's been excellent on controlling costs. We are always looking at exceptions and managing it on that basis. The biggest part of our costs are leases and people, and last year people got an average of just over 5% increase, and hence we were able to manage our costs at that level.
And you mentioned leases. I know the group is rolling out smaller stores. Does that also bode well for that operating expense because you are using smaller spaces?
Yes, over the long term it will. We only have 7 of those stores at this stage. So,
Okay.
but yes, they do come with smaller space and typically less rental payments.
And how has the reception been like to those smaller stores? And in terms of stock, what are you leaning towards providing in those stores? Are we seeing the more decorative, decorative items, tiles being provided in those stores, or is it a mix like the bigger stores?
So we probably chose the wrong word to say it's a smaller model. It's probably an alternative model, but what it means, it's smaller on the roof and sometimes a bit bigger in the yard.
Okay.
So we typically have all the categories in that store, but maybe not as wide a range of all the categories. But we do stock all the categories.
Before I let you go, Werner, talk to me about your capital allocation for the year. You are still opening up stores, closing some, and refurbishing some stores. Is CapEx being directly spent there?
Yes, that is our focus. You know, we want to invest in our business and make sure that we can gain market share by opening stores in these tough times. It's not easy to achieve, but we are making headway. We've launched two different store formats as well during the 6 months, and we will continue allocating CapEx into that direction.
Werner, thanks so much for your time and just taking us through the 6 months that was for Cashbuild. That was Cashbuild CEO Werner de Jager.